Although world equity markets remain in positive territory year to date, March saw a sharp increase in volatility due to the combination of geopolitical pressures from the Middle East and North Africa and the earthquake in Japan. Most markets fell on concerns that these events would have a negative impact on economic growth. Japanese equity markets were down 7.9% on the month in local currency and down 11.4% in euro terms. They did, however, rally from their lows over the last week of the month, as there were signs of containment of the Middle East tensions and hopes that reconstruction efforts in Japan would lead to a rebound in growth in the second half of the year and into 2012. The ECB signalled rate hikes at their March meeting as inflation risk over the medium term rose. Inflation came in at above the target rate of 2% for the fourth month, and Trichet noted that strong vigilance was required. Since this meeting, we have seen an interest rate hike of 25 basis points, and the market is pricing in a rise to 1.75% by the year end. The Portuguese situation continued to worsen, with the Prime Minister tendering his resignation after the minority government failed to pass the austerity package. Portuguese yields continued to rise to new highs, forcing Portugal to eventually request a bailout. Ireland released details of the bank's stress tests, announcing a requirement of $24 billion to recapitalise the going concern banks. This was well received by markets and gave relief to bond yields, as it was seen as a credible test. In a surprise move on the 11th of March, the Euro Area Summit meeting released further details on the extension of the EFSF and future of the ESM. The EFSF lending capacity is to be increased from $225 billion to $440 billion. Additionally, it will be allowed to purchase sovereign bonds in the primary market under exceptional circumstances. They also agreed to reduce the interest rate charged to Greece by 1% and increased the term of the loans from 3 years to 7.5 years. In the case of Ireland, there was no change to the rate, as the Irish government refused to change the 12% corporate tax. The ESM will be extended to $500 billion in 2013 and additionally will be subordinated only to the IMF loans. The exact details regarding the enhanced size of the EFSF were not agreed and are expected to be finalised at the June meeting. Commodities have continued to rally and rose over 4% in the month. This was largely driven by oil, which at $107 per barrel was at a 2.5-year high. With the Libyan conflict dragging on supply, upward pressures on oil are likely to continue, and oil is expected to continue at elevated prices. Food prices were also at all-time highs, with grain rising sharply due to fears that the US supply is not keeping pace with increasing demand.